Hello to everyone, and welcome to this review session for the CFA Level 3 exam. My name is Jad. I'm very happy to be with you today. This session is organized with the CFA Society of Lebanon. So thank you, CFA Society of Lebanon, and President Alia and the rest of the staff, the board, for collaborating on organizing this session, which I hope will be beneficial for all CFA Level 3 candidates today. Also, it's really a pleasure to have CFA Society of Cyprus, Kuwait, and Egypt also collaborating on this and sending the invitations to their members. So before we start, so as I said, my name is Jad. I've been teaching the CFA actually Level 3 exam for more than a decade now. It's level 3 is actually quite different compared to levels 1 and 2, as you are already aware by now. So hopefully this session will try to provide an exhaustive review for the derivatives and the fixed income section. At any point in time, please, if you have any questions, if anything is not making sense, please feel free to send any question you have on in the chat section. So just make sure to send me any question you have, even if it's a question outside derivatives and fixed income. If we have enough time, I'll also make sure to tackle it. So that said, we'll start with derivatives. I also received a couple of questions that I will also make sure to tackle during this session. Yes, the session will be recorded. It will typically be available on the channel maybe a couple of hours after we end. So for those who cannot attend live, it will always be possible for you guys to watch the recording later. Great. So we'll start with derivatives. Again, feel free at any point in time to send me any questions you have here. All right. So let's start. A second while I share the screen. All right. So for the derivative section, what are the important testable concepts? What are some ideas, formulas that you need to master in order to be able to perform well on this section on the exam? You have many formulas, many concepts. Things can get quite complicated. So we start with simpler things, starting with option positions, using options to create synthetic securities, and making sure that you guys are quite familiar with the concept. So in options, we'll tackle synthetic securities, option strategies, calendar spreads, the volatility skew, and the volatility smile. All right. And then we move on to futures, forwards, and swaps. So let's start with how to use options to create synthetic securities. This part should be really something that I would say I would consider as easy, and any CFA level 3 candidate should actually master quite well. So a good framework to start with is the put-call parity, where a call plus an investment in the risk-free rate, right, the risk-free asset, with a maturity that equals that of the options, right? And of course, the options are European, is equal to an investment in the stock plus a put on that stock. You guys know that the left-hand side is called a fiduciary call, while the right-hand side is called a protective put. For European option, this equality will always prevail, or else there would be arbitrage opportunities. For American options, of course, you need to be aware that American options are exercised, can and sometimes are exercised prior to their maturity. So this needs to be factored in, which is outside the scope of the curriculum. Now, looking at this formula that you can very simply demonstrate by looking at what happens at the end of the investment horizon, whether you invested in the left-hand side or the right-hand side, there are actually two possibilities at the maturity of the options. A quick reminder, the call and the put are European. They are written on the same stock S. They have the same expiry date, the same strike, and an investment in a risk-free asset has a face value equal to the strike of both the call and the put. Now, what can happen at maturity? At maturity, you could have the stock closing above the strike. So the call option is in the money, the put option is naturally out of the money, at which point the value of C plus PVX would be the following. The call would close in the money, so it would pay you S minus X at maturity. Now you have your investment in the treasury bill that actually matures and pays off the par value, where you can clearly see that negative X and plus X would offset. Now, the value of the protective put in the same scenario where the stock closes above the strike, the stock would be worth whatever it is worth at that point, so ST. The put will be out of the money, so worth 0. Now we consider the second scenario where the stock closes at or below the strike price, at which point the call option is out of the money and would pay off 0. And your investment in the treasury bill would actually pay you off the par value of X. What happens to S plus P in the scenario where S closes below the strike? The stock is worth whatever it is worth at that point in time. The put is in the money if the stock closes below the strike. So the put would pay off the difference between X minus ST, the strike minus the stock price. Of course, you can see how the STs here would naturally offset, leaving you with the strike. Bottom line, whatever happens to the stock at maturity, whether the stock closes above the strike or at or below the strike, you have the two positions being worth exactly the same. ST in the scenario where the stock closes up and X in the scenario where the stock closes down. So at maturity, these two positions will always have the same value. Owing to the law of one price, if they have the same value at maturity, then they would have the same value at any point in time. And this allows us to create the put-call parity. All right? So again, if you guys, anything is not clear, please make sure to stop me. Great. So now we look at how do we use the put-call parity to create synthetic positions. So if we have C plus present value X equals S plus P, this allows you, and please be ready on the exam, to replicate the payoff of any security by using this parity relationship. So what if on the exam, they want you to create a synthetic short put? That is, establish a position that would actually behave like a short put. The negative here refers to the fact that you want a short put position. Then all you have to do, if you don't want to memorize all these relationships, is actually to remember the put-call parity formula. So what you guys do now is that you isolate P, you isolate negative P, and look on the other side of the equation, what is the position that corresponds to a negative put position? All right. So if I take P this way, then you have S minus C minus the present value of X, which simply means that to establish a short put position, you could actually buy the stock, sell a call, and short actually a treasury bill. When you short the treasury bill, the money will actually serve to finance a large portion of S, because remember that when you short a put, you actually make money. You actually earn. It's not that you make money in the sense that you already have a winning position, but it's a credit position, meaning that money flows in when you short a put. So you can create a synthetic security using derivatives. And here, to create a short put, you are using a call in addition to the stock. You could create a synthetic position in the stock without actually buying it, by buying a call and investing in a treasury bill and also selling a put. And notice how, beyond the mathematics, this is a very simple reality here, because when you buy the stock, you make money if the stock goes up. That's the role of the call, right? You lose money if the stock goes down. That's the role of the short put, because you have sold someone the right to sell you a stock. If that stock goes down, then you'd lose money. And of course, your investment in PVX is actually just setting the money aside to make sure that when the time comes to exercise the call and buy the stock, you do have enough money equal to the strike to actually buy the stock. So here you have used calls and puts to replicate a stock. The last thing before we move forward is to actually recognize that we can use options to replicate a forward. If you buy a forward with a price of 100 on a given stock, this or an asset, this means that when the underlying asset goes above 100, you make money. If it goes below 100, you lose money. So this is similar to buying a call with a strike of 100, which would actually replicate the upside of the forward. And you would also sell a put also with a strike of 100, meaning that when the underlying goes below 100, you selling the put would result in losses because someone has the right to sell you the stock at 100 while the stock is worth less than 100. So you are using options to actually replicate another derivative, which is a forward contract. Note before we leave this concept that the same put call parity here can actually be replaced, right? Can actually be modified to make it a put call forward parity. Because instead of S here, look at the formula here with me. So here you have an S. And you know that absent any benefits or cost, to make things easy, the forward is simply the stock into 1 plus RT, right? So I could actually replace the stock here by F divided by 1 plus RT. Bottom line, to replicate a forward, right, you need to move the put to the other side of the equation where it becomes a negative, meaning that you'd actually buy a call and short a put, which is exactly what we did here without using the put call parity. So pausing for a second, right? Any questions? All right, so this is what I'll be doing today. So you guys make sure to, at the same time, try to enjoy the review and make sure that these concepts are well known to you. And if you have questions, please chip in immediately. So we have reviewed together quickly how to use options to replicate the payoff of either other underlying assets or other derivatives. We now move to tackle another concept, which is option strategies. So on the exam, you have several strategies that you need to master: covered calls, protective puts, bull call spreads, bear call spreads, spread strategies with puts, you have straddles, strangles, you have calendar spreads. Of course, when we discuss these strategies, to make sure you're ready for your exam, you need to be able for each of these strategies to calculate the profit given any underlying price at expiration. You need to be able to calculate the break-even price, the maximum profit, the maximum loss, etc. But on top of that, as level 3 candidates, you also need to be able to recommend the best strategy given a potential outcome. So if you expect the underlying to be very volatile or not, if you expect volatility to decrease on the long run, etc. So based on any scenario, you need to be able to recommend which strategy would actually work. So I know that many candidates, unfortunately, would go on and memorize all these formulas of maximum profit, maximum loss, break-even price, etc. for each of these positions. While in reality, just by understanding what each position is about, you can recreate these formulas extremely quickly on the exam, as fast as actually memorizing them or writing them out of memory. But of course, keep the memory for other concepts that would actually require memorizing things and not for derivatives and formulas. These are much simpler and do not really require you guys to memorize them. So let's take any position, like for example, a bull call spread. It is really typically the case that if you just know what the position is about, you are able to derive all these formulas without, as I said earlier, memorizing them. So what is a bull call spread? So whenever you see a spread, a quick way to remember these, whenever you see a spread here, you're buying an option and selling an option, and you're doing that with calls. So you guys will be buying a call on a given stock that has a given expiry date, a given strike, and then you're selling a call on the same stock, same expiry date, but different strike. Which one will you buy and which one will you sell? This is the key. This is the one that gives the answer away, a bull call spread. I think that this can actually be very helpful when the positions become more complex. So think about it this way. This is the low strike and this is the high strike. You want to buy one, sell one. We're talking about calls and it's a bull strategy, meaning that it should make money when the underlying stock goes up. We know that when the underlying stock goes up, options are in the money. So the only way you can make money if the stock goes up and you want to buy one and sell one is to be long the low strike call and short the high strike call. So for example, a strike of 10 and the strike of 15. Now what happens here is also very simple. At any price below $10, both options are out of the money. So both options are worthless and you definitely lose your net investment. So this is a debit spread position because you actually buy the low strike call, which is more expensive than the high strike call, all else equal. It has more intrinsic value, right? And a higher probability of finishing in the money, all else equal. So let's say you're buying this for $1.5 and you're selling this for $1. Your net investment is a negative $0.5. Now, it's not sufficient that the long call position be in the money for you to make money. Because remember, you have paid $0.5 to acquire that position. So try to speak these formulas. It always makes more sense than memorizing them. So you need the option that you are long. Let's color it here in green. That's the option that you actually purchased. And that's the option that you shorted. So to break even, you need the option that you purchased to actually be in the money by $0.5 so that you recoup, you offset the initial investment. This clearly translates to a price of 10.5. You need the stock to reach 10.5 so that the long option has enough payoff, which is 0.5, to actually offset the net investment that you had to pay to acquire the position. And then, of course, from that point on, it's pure profits. And your profits would keep growing as long as the stock goes up. But remember that as soon as the stock reaches 15, the option that you sold is actually now in the money and would offset any gains on the long option. So beyond 15, you're neutral. No more money is to be made. No money is to be lost. There is a cap on your profits. This is how I advise that you actually be aware or know each of these positions. You need to know what it consists of. So, for example, a bull call spread is a long call with a low strike and a short call with a high strike. With that in mind, you are able to write all these formulas without actually memorizing them. So we're long a low strike call and we're short a high strike call, right? So what is the expression for the profit on that position? That's very simple. The profit will be so look at the first option, the one that you purchased. It would pay you off the maximum between 0 and ST minus XL. That's the option that you purchased. Now there's an option that you sold, so negative. This one would make you pay or lose the maximum between 0 and ST minus XH. And then never forget that to acquire the low strike call, you had to pay a premium. I'm calling it CL. You can call it C1, whatever you like. And when you sold the high strike option, you actually cashed in CH. This is the expression for profit. Now you plug in any stock price, you have the strikes, you have the premiums, and you obtain the profit. Now, what about the maximum loss? What's the worst thing that can happen? Go back to this diagram here. The worst thing that can happen is for the stock to go below 10, at which point both options expire out of the money. So the maximum is that you would lose your net investment. Of course, you bought a call option for CL, you paid CL, but you cashed in CH. So this is your maximum loss. Now, this is expressed as a positive number, but it's a loss. Some people actually like to write it as CH minus CL, and the number would be negative. Both ways are fine as long as you understand that your maximum loss is whatever you actually paid to acquire the position. All right? So a quick and easy way to actually remember how to tackle these positions. Now, what's the maximum profit? What's the maximum? What's the best case scenario? Go back to the diagram. The best case scenario is for the stock to go up. But remember that if it goes above 15, you cannot really enjoy any extra return. The maximum you can actually have is when the stock goes up above 15. So the maximum you can do, your maximum profit, is actually the difference between the high strike and the low strike, which is 15 minus 10 in my example. That's the best you can actually make. Of course, you need to reduce that by the premium on the call that you purchased and increase by the premium on the call that you sold, CH. And finally, what's the break-even point? I'm saying it again, only an excellent understanding of what the position consists of, right? And really understand how it's done rather than memorize these formulas. Imagine you have to memorize these formulas, but for 7, 8, or 9 different positions. It is really not easy to do that. So what's the break-even point? The break-even point is where your profit is actually zero, by the way. So some people would simply set this expression equal to zero and actually solve for the stock price that makes the profit equal to zero. But this will only work if you know in which area the break-even occurs. So if you go back here on this diagram, we know that the break-even occurs in this area here, where the short call is out of the money. So you can go back to this formula, take out this part because the short call is out of the money, and then set this equal to zero and solve for ST. A much simpler and direct way is just to have a good, very solid understanding of what the position is all about and say the following. Since I paid a net premium, I break even when the stock goes above the low strike, right? The stock needs to go above the low strike by enough to offset the net premium that I paid. So in my previous example, that's the 10.5. I like to speak the formula and never memorize it. The stock needs to go above the low strike, above, you see, positive, by enough to actually cover the net premiums paid. All right, you need to do this for each and every position. This was a bull call spread. Investing the last 1 minute in this concept, what if it was a bull put spread? Then this would actually make it a lot easier on you to figure out everything you need to actually figure out for this position. So draw this diagram. We're now using puts. So there is one put with a low strike and one put with a high strike. We want to buy one, sell one, and we want to make money when the underlying goes up. Now listen carefully. When the underlying goes up, we know that put options expire worthless. So how can I make money when these puts expire worthless? Because as I said, when the underlying goes up, both puts will expire worthless. So I want to be in a position where when they expire worthless, I make money. So the only way for this to happen is to sell the high strike put, collecting a higher premium, PH, and buy the low strike put, incurring the lower put premium, so the net would be positive. Notice that, similar to the bull call spread, we also end up buying the low strike option and selling the high strike option. Except that in a bull call spread, we need to pay a net amount of money to do that. while in a bull put spread position, we're actually cashing in. That's a credit spread position. When you do that, you're selling the high strike put, which is typically more expensive because it allows you to sell the same asset at a higher price. So let's say you collect 1.6, and next you buy the low strike put. Let's say you incur negative 0.8. So the difference is plus 0.8. This is your maximum profit. That's the best that can happen to you if the stock goes above XH, right? Theoretically, now we'll factor in, of course, the break even. But for any price where the two options are out of the money, then what you're hoping, your bet is to actually keep the net premium received. Now, definitely because it's a position where you start with a cash inflow, then you break even slightly before the stock actually goes above XH, right? Since you already collected 0.8, then you can actually, if the position, if the stock, as I said, closes above XH, right, then you're making money because you can keep the 0.8. Now, what I was saying is, even if the stock closes below XH, at which point the option that you sold is actually making you lose money, it's fine as long as you don't lose more than 0.8. So let's put some numbers. This is 10 and this is 20. Remember that you collected 0.8. So you can allow yourself to see the stock at 19.2 and you're breaking even. Because when the stock is at 19.2, the put option that you sold is making you lose $0.8. These $0.8 are actually offset by the net premium collected. So the break-even point is actually 19.02. And any price above 19.02, you're making money. But do remember that your maximum gain is $0.8. Now, any price below 19.2, you're losing money. So you can lose money and your loss would increase until the stock reaches 10. That's your maximum loss. The maximum you can lose is the difference between 20 and 10, which is $10, reduced by the 0.8 premium collected. Any price below 10, you're no longer losing more because you actually have a long put position that becomes alive and that would offset any losses that you are taking on the short put. So both will have a very, very similar profile in terms of direction, right? Both a bull call and a bull put spread make money when the stock goes up, but they make different kinds of money. The call spread makes a larger chunk, which is the difference between the two strikes. The put spread, the bull put spread, can only hope to make the net premium. They have a similar profile in terms of direction. So pausing here for a second to check whether you guys have any questions, any comments. If you would wish to put more time on a specific topic, less time on a specific topic, please make sure to let me know. So one topic that is a bit tricky sometimes is the calendar spread strategies. So all the spread strategies that we've seen earlier and that you're familiar with, bull spread, whether for calls and puts, and bear spreads, whether for calls and puts, you're actually using call options expiring on the same date. The difference is in the strike price. In a calendar spread, you're actually betting on something completely different. So in a calendar spread, you're actually trying to profit from time decay or have an opposite bet. Typically, when you implement a long calendar spread position, what you're doing is the following. You're actually selling, so you short a short-term call option, for example. So you short a 1 week, let's say, call option on stock ABC with a strike of 10, and you go long a 1 month call option on the same stock ABC with the same strike of 10. So in calendar spreads, You are long a call and short a call, but this time they have the same exercise price. They differ by maturity. And what is the main idea behind that is to profit from time decay. Options, whether calls or puts, when you look at their market value, you can split it, as you guys know very well, into two components: intrinsic value and time value. Of course, time value has also volatility value, but let's now zoom in on the actual time value in an option. This time value reflects the fact that, in general, the longer the time to expiry of an option, the higher the value. Because a longer time horizon would actually increase the probability of whatever you want to happen happening. So you would pay more money because of that increased probability, owing once again to more time remaining. Of course, there are exceptions, like deep in the money European put options, where time becomes your enemy. You don't want too much time, and with every day that passes, the option actually gains value rather than losing. But for except these exceptional cases, here, every day that passes, the option would lose some of its time value. Now, it is a fact that we actually, as you know, we measure this decay by theta. So the theta of the option is actually how much the option loses for every 1 day that passes. Theta is typically negative, as I said, because every day that passes, the option would lose some value. Now, what you need to remember and be super familiar with is that this loss is absolutely not uniform. Theta becomes larger and larger as the option approaches its expiry. And a very simple way to understand this is to take a simple analogy. So let's say you are playing a football match or any other kind of sport. And let's say, for example, you have 90 minutes. It's a game of 90 minutes. So you start with a score of 0-0, and then suddenly you take a goal. So you're 1-0 down. So imagine you took a goal in the first minute. So now you have 90 minutes to actually try to score. Now, when the first minute actually passes, that's obviously not good, but that's not catastrophic because you still have 89 minutes remaining. In other words, the 1 minute that passed is only one out of 90. Now, I want you to fast forward. There are only now 7 minutes left for the game, and you're still down 1-0. Now, the next minute that passes hurts you way more because the remaining is only 6. In other words, it's 1 minute out of 7. Take the example to an extreme. With 2 minutes left till the end of the game, the next minute that passes is half the life of the game, right? So it is half the life of the game, which means that it hurts you way more. And as you can see in this very simple analogy, theta is not uniform. When you approach the final whistle, for the case of options, it's the final maturity, every day that passes hurts you more. When there are 2 days to maturity, the next day that passes is half the life of the option. That's a lot. And the value that is lost is a higher value compared to the previous day and the previous one and the one previous to that one. So theta, the decay, is actually exponential. This is the idea that investors who engage in long calendar spread positions actually pursue. They know that the theta of the 1 week call option is much higher than the one for the 1 month call option, meaning that with every day that passes, the 1 week call option loses more money relative to what the 1 month call option would have lost. And since you're short the one that loses more money, you're long the one that loses less money, you're a net winner. When the 1 week call option expires, it has lost all its time value. The time value that would have been lost by the 1 month call option, which is now a 3 week call option, would actually be lower. You lost less. Net, you make money. Of course, this is absolutely not a risk-free strategy because things could happen. Short-term volatility could spike. right? There could be a super high volatility for the next week because of an event, because of an unexpected event that brings uncertainty, and that uncertainty is expected to be resolved within the next week. So the short-term volatility would actually increase, which means that the 1 week call option would increase a lot, while the 1 month call option would actually not increase, meaning that you would lose more on the option that you're short compared to the gains or no gains on the 1 month call option, especially if at some point you have to lift the strategy and you have to actually unwind the position. This is also where losses could emerge. So the different the volatility term structure, i.e., how the volatility differs from a 1 week period to a 1 month period starting from today, would actually have a huge impact on how this position would actually behave. Of course, I could add, but I think that it's not really mentioned in the curriculum, you should also consider delta risk. Because depending on whether these options are in the money or out of the money, their deltas are different. If these options are in the money, then the 1 week call options would have a higher delta, right? Because delta converges to 1 or 0 as you approach maturity, depending on whether you are in the money or out of the money. This means that you have delta risk, meaning that if the underlying goes up and the delta on the 1 week call is higher, then the 1 week call would increase more than the 1 month call. And there's a net loss because you are short that one and long that one. Of course, if the options are out of the money, then the 1 month call would typically have a higher delta. So a drop in the underlying asset would cause the same impact. Bottom line, keep in mind that these strategies are absolutely not risk free. No, so Ahmed, the session will actually be saved, right? It will be posted on the channel. So I have a question to illustrate the bull spread with numerical example. I think I've done that. Let me know, please, if you need me to go through another example, Abdel Monem. So let me know if you still need a numerical example, because I think I've done that. Why on short calendar spreads we would deal with option away from ATM, unlike long calendar spreads. So yeah, no problem. When we reach fixed income, we'll do that. So remember what I said about the deltas of the options, right? And how they would actually react with the changes in the underlying asset. In a long calendar spread, you can actually work with at the money because you are selling. Okay, so that's a good question. Let me also illustrate the fact, right? When does an option have the highest time value? Remember that these calendar spread strategies are there to capitalize on the time component. And this is actually your answer, right? So when does an option have the largest time value? These are options that are at the money. And I remind you, look please at this graph from, you know it from level 1. So let's look at a call option, right? So this is a call option, and this is the strike, and this is the x-axis is for the stock prices, right? So in red, I'm showing you the expiry value of a call option. For any price below the strike, the expiry value of the option is 0. You agree with me, right? And for any price above the strike, there's a 1-to-1 relationship at expiry, and the call option will have a payoff that is 1-to-1 related to the stock price. Now, this is the value of the call at expiry. The value of the call prior to expiry, you need to add time value. So when do you have more time value? Let me show you and convince you. Time value is very little when the option is deep out of the money. And I'll show you why. And then time value is largest when the option is at the money. And then time value is actually small for options that are deep in the money. So this is your answer, understanding that at the money options are typically the ones with the largest time value. So any strategy that is capitalizing on time value decay, right, and not on volatility changes, different relative volatility changes, would actually work with options close to at the money to capture, to profit from time decay. You need to have time value. If you sell an option that has already no time value, then time decay is actually meaningless, right? So why in this area is time value very small? Because very simply, let's always take an extreme example to understand the idea. Let's say you have a call option on a stock with a strike of 100, but the stock is worth today 5. Would you really care if the option was a 3-month or a 6-month option? In both cases, the probability for the stock to multiply by 20, right? That's a company where the prospects are that the company would grow like 20 times, right? So the company value is multiplying by 20 over the course of 3 months or 6 months. It's 0. So here you could say that for deep out of the money options, you don't really have time value to bet against. Same goes for deep in the money options, because whatever you wanted to happen actually happened. You're not really anymore paying for time. Imagine now the stock is $617 and you bought the call option strike 100. That's like buying the stock. Delta is 1. So there's a 1-to-1 relationship. You're not really paying for time. Time has no meaning here. It's like buying the stock, but just using some leverage. Do you understand? So let me know, please, if you understood my comment. So bottom line, you typically play in this area whenever it's time decay that you're betting against or on. Now, of course, if you're doing the opposite, it's probably not a time decay thing. It's a volatility shifting thing. It's a volatility shifting strategy, right? So do let me know if my answer is clear to you. All right. Good. Closing the options section. So I have more or less budgeted or devoted like an hour and a half for derivatives and an equal time for fixed income. But as I said earlier, please feel free to drop your questions. I have taken note of the part on active strategies. We'll talk about these a bit later. All right. So the final thing, volatility smile and volatility skew. So obviously, an important idea to know is that implied volatility is not the same. And that's really confusing for many people who are new to options, because think about it. If you're buying a call option on Apple, then what you should factor in the valuation model to price this call option on Apple should be the volatility of Apple stock. Theoretically, you shouldn't care about the strike of the call option, right? You shouldn't care whether the strike is actually 150 or 160 or 145. The volatility of Apple stock is what it is, and it's not really dependent on the strike of the option. Of course, the volatility itself is not dependent. But the implied volatility, i.e. the volatility that is priced by investors in the valuation model, does change based on the strike of the option. So the volatility smile, and I'll discuss risk reversals here because for some candidates, I know that they could be a bit tricky. So the volatility smile is the fact that at the money options typically have the lowest implied volatility. So this is IV and this is the strike, right? So at the money options typically have the lowest implied volatility compared to in and out of the money, both calls and puts. That's the volatility smile. A quick reminder, implied volatility again is not actual volatility. Implied volatility is what investors believe volatility would be, and this is what is factored in the pricing model. So the volatility skew refers to the fact that implied volatility would fall as you observe higher and higher strikes. So conclusion, if you look at out of the money puts, right? So imagine the stock is priced at 60 today. So 60 is the strike for the ATM call and put. So a 20 strike put would actually be more expensive, right? Being out of the money than an equivalent out of the money call, for example, with a strike of, let's say, 100. So again, the stock is 60 today. If you take a strike 20 put, you would see that the implied volatility is higher, even though the put is out of the money, right? When you compare it to an out of the money call, an almost equivalent out of the money call, you would see that implied volatility is much lower. Now, do remember with me that implied volatility goes up and down when all else remains the same, except that the option prices start to go up and down. And the explanation to that is typically crashophobia. The fact that investors would actually buy out of the money put as protection against tail risk. If catastrophic events in the market happen, right, then you have this deep out of the money put that would actually protect you. So this volatility skew is all about the difference between the implied volatility of an out of the money put and the implied volatility of an out of the money call. And whenever this difference increases, it means that investors are more bearish. It means that investors are more nervous and they are bidding up the prices of puts, right? So they are bidding up the prices of puts. And again, it's really very important for me that you understand that implied volatility goes up and down because the price of the option is going up or down, all else equal. The price of the option is going up, but the stock has not gone up or down. The risk-free rate has not changed, right? Nothing has changed except the implied volatility, except investors' expectations. So this difference between the out of the money put IV and the out of the money call IV or implied volatility, whenever it widens, it's clearly showing you guys that investors are bidding up more and more out of the money puts, meaning that they are nervous about something. They are flocking, they are really going and trying to buy a hedge against extreme scenarios more than they are expressing any form of optimism by buying deep out of the money calls, right? Some investors actually bet against or bet that this measure would actually shrink. I got this question several times, and I'd like to clarify that point because, okay, excuse me, I'm just not. All right. So as I was saying, this is a question I received several times. What's the difference between risk reversal and a caller? At the end of the day, you might end up actually holding the same assets. So let me remind you, what's a caller? A caller is when you buy a stock, you actually sell a call, by that capping all your potential upside profits beyond the strike of the call, and you would buy a put, by that flooring the potential losses. So if you bought a stock at 20, let's say you sell a call strike 25 and you buy a put strike 16. Now you know that whatever happens, you can only sell your stock at best at 25 because you have sold the call. And the worst you can lose is that you will have to sell your stock at 16 because you have a put allowing you to do so. So that's a caller, where you end up selling a call, buying a put, and holding the stock. Of course, I admit that a risk reversal ends up also having the same position, right? You will also end up having the same position, and to see that, I'll keep that position here. And I want you to remember, we are discussing the difference between implied volatility on the out of the money put and implied volatility on the out of the money call. If you believe that it will actually shrink, right, then you will implement a risk reversal. So if you think it will shrink, then you're better off buying calls and selling puts. Why? Because if the difference between the IV of the put and the call would actually fall, it means that even, again, I have to interrupt myself and actually say that you're not betting. Please beware on the exam. Those are what I would call hard questions on the exam, right? This concept. I'm not betting against implied volatility dropping or increasing, not at all. I'm only betting that the difference between the IV of the put and the IV of the call will narrow. I don't mind if both IVs go up, as long as the IV of the call goes up by more. The difference will shrink. I don't mind that both IVs will actually fall, as long as the IV of the call falls by less. Then again, the difference would shrink. Of course, the best case scenario would be that the IV of the put would fall, the IV of the call would go up, the difference would shrink even faster. A risk reversal is meant to profit from that shrinking in the difference in IVs. By the way, hence the word risk reversal, right? So I go long a call and short the put. Now imagine IVs go up all the way, but IV of calls go up faster. So I will lose on the put because the put goes up because of the IV going up, I lose. But because of the implied volatility on the call going even higher or by a larger amount, then what I gain on the call is actually more. And the net is a positive amount. Now, definitely you would ask me, guys, but you have created delta risk. And of course, I'm the first one to admit it. By shorting a put and going long a call, they don't necessarily have the same delta. So you would calculate the, actually, I have to correct myself, right? Because the call, the delta on the call is positive. Forget my last sentence. The delta of the call is positive. The delta of the put is negative, but you have shorted it, so it becomes positive. So you have a positive delta exposure. How do you hedge that? By selling enough stocks to eliminate the delta exposure and only keeping a pure neutral IV risk reversal strategy. All right? This is why when you think about it, it looks like a caller, in that case, a short caller, where you short the stock, buy a call, and sell a put. Yes, you end up holding the same assets as in a caller, but they are done for different reasons. When you implement a caller, you actually have a stock, and your aim is to narrow the range where the stock can fluctuate. When you implement a risk reversal here, your aim is to actually benefit from your expectations of changing IVs and narrowing or widening of this volatility skew. Pausing for a second to check questions you guys might have. So let me know, please, in the comment section. All right, great. So just give me a quick second. Perfect, excellent. So this was a quick review on options. I now move to futures, forwards, and swaps. And by that, I want to also put some time on fixed income futures because I received several questions regarding these. All right, I just have, you guys cannot see my screen anymore, right? So let me know if you can see my screen. All right, excellent. Good. All right. So just a few seconds before we start. I have a slight problem with the... All right. All right. Excuse me for this slight interruption. I had a small issue with the PowerPoint I'm using. Okay, problem solved. So we can continue. Great. All right. So if there are no questions on options, please just let me know if you can see my screen. Okay. All right. That's great. So we move on to futures, forwards, and swaps. At the level 3 or for the level 3 exam, the use of futures, forwards, and swaps is typically for risk management, for altering the risk exposure, be it duration of a fixed income portfolio, be it the beta of a stock portfolio. So I'll be looking with you guys at how we use them very quickly. We look at variance swaps also, because I understand that it can be a topic that is a bit problematic sometimes, right? And we look finally at how we infer market expectations from derivatives. All right. So again, whenever you have any question, please feel free to interrupt. Great. I think that instead of memorizing, I'm not going to say complex formulas, they are not, but instead of memorizing the number of contracts, futures contracts to use, how to size a swap, etc., it really makes sense for everyone to understand this. You will start with a portfolio having a value of P and a given risk metric. I'm going to call it R. This could be duration. It's a risk metric because it measures the sensitivity of a portfolio to changes in interest rates. It could be beta because it measures the sensitivity of a stock for changes in the market. Whatever that risk metric, you will start with a portfolio having a given risk metric, RP. You want to combine it with a derivative, right, that has a given size. I'm going to call it N, and which itself also has exposure to that same risk factor or risk metric, which I'm calling RF. And when you combine that derivative with your original portfolio, the goal is always to end up with the same portfolio. Remember, derivatives are notional instruments. I'm not going to exchange anything. I'm not going to buy. I'm not going to exchange money. It's just a contract I sign. But once I sign it, it changes the exposure of my original portfolio. So mathematically, this continues to be correct. You want to end up with a portfolio P, but which now has an exposure to the risk metric that is different, which is a target exposure. Let us start by looking at futures to change the duration of a fixed income portfolio. And here I got 2 or 3 questions the other day, which I will make sure to also tackle. All right. So let's do it, guys. Look at this formula. There is absolutely nothing to memorize. And someone sent me a question regarding the conversion factor. Sometimes it's multiplied, sometimes it's divided. No, you'll see. By understanding exactly what happens, you'll understand that, as I try to always say, math is a language, right? You just write in numbers and in formulas what you can actually express in your own language. So let's use this concept for fixed income futures. So I start with a portfolio of bonds that has a given duration, P, right? I want to add a derivative to it. Let's start with a swap, actually. So I'm looking at how to size a swap. What should be the notional amount on the swap, knowing that the swap has its own duration, which I'm calling here modified duration of the swap. And I want to end up with, once all is said and done, I want to end up with the same portfolio, but which now has a modified duration, T, target. So let me first answer a very common question. Shall I use modified duration or basis point value? Every single formula can be written with one of the two elements because they are directly related. Let's isolate N. Remember that the whole idea is what should be the notional on the swap to actually take the duration from X to Y. And let's use numbers. So you have a portfolio of 100 million. It has a duration of 7, and you want to bring it down to 3. And you want to use a swap. So let's size the swap. The swap, remember, will enter the portfolio and result in you having the same exposure, like the 100 million, but now with a different duration. So let's isolate N. It's very simple. It's mathematical. So you have P, the portfolio, multiplied by the modified duration target minus the modified duration of the portfolio divided by the modified duration of the swap. That's it. That's your formula. So you don't really need to memorize it. You just need to start from this, which is for me the root of all the formulas that are used in that chapter. You start with a portfolio, it has a given duration. You want to transact in a derivative that has its own duration, where after everything is said and done, you end up with the original portfolio, the one you initially had, but it now has a different risk exposure. Now you plug in 100 million, 3 minus 7, and you have to know what the duration of the swap is. And on that point, making sure that everybody is on the same page, a duration has a swap. A swap has a duration, right? A swap has a duration. So let's say you are in a swap where you pay fixed 5 years and you receive floating 1 year. This is exactly like going long a 5-year bond and short a 1-year bond, right? Of course, the duration of the swap is the net duration. When you enter a pay 5-year fixed, receive 1-year floating swap, it's as if you have shorted a 1-year bond and used the proceeds to invest in a 5-year bond. The net duration of the swap in that case is the difference between the duration of the asset side of the swap, which is so I've said this exactly the opposite. I'm very sorry for it. So, excuse me, rewind, right? We're live, so I just correcting myself, pay attention. I said pay fixed, not receive fixed. So a pay fixed swap means that you shorted the 5-year fixed rate bond and you went long the 1-year floating, of course, because you are receiving the 1-year floating, so you're long that bond synthetically. And you are paying a 5-year fixed, so you are short the 5-year bond. So that said, this swap has a net duration, which is the difference between the duration of the asset side here. Let's say it's 0.5, half of the 1 year, right? Minus the duration of the liability side. So let's just approximate it at 3.75, for example. On the exam, of course, you will have the actual numbers, but I'm saying that the duration of a 5-year bond is closer to 375. whatever the real number is, the actual duration is negative 3.25. By the way, that's something you should be super quick at for the exam. When you want to use a swap to lower the duration of the portfolio, you want a swap with a negative duration. Hence, you enter a pay fixed, receive floating swap. So here you plug in 100 million goes here for P. The target is 3. The portfolio actual duration is 7. And the modified duration of the swap is negative 3.25. This would solve, guys, for the size of the swap that will allow you to bring the duration of your portfolio from its current value of 7 to its target value of 3. Let me know if you have any comments or issues. Excellent. So that said, I'm sizing a swap. All right. Now, what do we do if the idea is to use fixed income futures? And here I invite especially those who are not very familiar with the conversion factor, how is it used, and why do we use it, to pay particular attention. All right? Great. So one more time to show you that I cannot memorize formulas, right? Nobody can try to give a session on several topics and actually have all the formulas every time, right, in their mind. It's impossible. You need to be able to understand them once and for all and be able to recreate them quickly. So one more time, the idea is basic. I have a portfolio, and I'll do it, by the way, for duration and for basis point to show you that they are equivalent. If on the exam they give you duration, use it. If on the exam they give you basis point, use it. Don't waste time going from one to the other because you only memorized one formula. Don't do that, right? Excellent. So I'm starting with a portfolio of bonds, and they have their own duration P. I want to include, I'm solving for, what's the number of futures contracts, right? So what's the number of futures contracts? Multiplied by what's the price of each of these futures contracts, right? Because if I take one futures contract, it could be on $100,000. If I take two, it becomes on $200,000. So the number of futures contracts multiplied by the price of the futures contract. Note how in the swap example, you don't need that because you do one swap. So when you size the swap, N is already number times F. Now, the futures has its own modified duration, all right? And as always, the whole idea is I'm bringing a futures position to a bond position, and the end result is to have the original P, but which now has a different modified duration. First, we just solve for the number of futures, which is very simply P into the target modified duration minus the actual modified duration divided by the modified duration of the futures, and P is divided by the value or the price of each futures contract. This is a formula that you guys need to know very well, right? If we work instead of with modified duration, if we work with basis point value, let me show you the equivalence, very easy. What is the basis point value? It is the dollar change in the portfolio for a 1 basis point change in yields. So it's P times the duration of P times 0.001. That's 1 basis point or 0.01%, right? So basically, if you go back to my original formula, the one that I solved for here is the one that uses modified duration, because it would be too bad, guys, if on the exam you only memorized the BPV version and they give you the modified durations. You are losing time coming up with the BPVs. No, you can use this form of the formula. It also works. Now, look please at my formula. Here, when I multiply P by modified duration T by 0.001, so multiply everything by 0.01, which actually changes nothing to the equation, correct? If you have a fraction and you multiply up and down by the same number, it changes nothing. So I'm going to multiply up and down by this 0.001. Then P times modified duration T simply becomes basis point value T, right? Owing to this. And then P times modified duration P times 1 basis point simply becomes basis point value P. Now, the future price multiplied by the duration of the futures multiplied by 1 basis point simply becomes BPVF. That's it. You guys have the choice on the exam. If you want to use the BPV version of the formula, then it's simply target basis point value minus actual portfolio basis point value divided by the futures basis point value. And if you are given modified durations, then the form is very similar here, except that you need to factor in the scale, the ratio of portfolio to futures price. All right, so you guys have both versions. Let's work with any one of these two versions, and let me explain for those who sent the questions regarding the conversion factors how things are done. Great. So guys, in real life, a bond futures contract, okay, so let's take a step back. What is a gold futures? It's a futures where you need to deliver gold and receive money, or actually pay money and receive gold. The idea is it's gold, right? What's an oil futures? Same with oil. What is a bond futures? Same with bonds, not one specific bond. There is a list of several deliverable bonds that can actually be delivered in satisfaction of the futures contract. And it's the short side, naturally, the one who will deliver the bond and earn the futures price, who can decide which of the deliverable bonds can actually be delivered. So please understand that in a bond futures, there is a list of deliverable bonds. However, for simplification and actual calculation of the CF, I want you to think of the bond futures, what it is actually, as a bond futures on a specific bond. For example, the 30-year bond. A bond futures is a futures on a 30-year bond. However, there are several bonds that can be delivered instead of the 30-year bond. But this could be unfair, right? So I'm trying to simplify as much as possible for those who do not have yet a good grasp of the concept. But this is very important to understand the formula, how it will emerge, right? And the CTD, the basis point value of the CTD, the conversion factor, etc. So one more time, a 30-year bond futures is a futures on a 30-year bond. But there are several bonds that could be delivered instead. Now I want you to look at what I will call the quoted futures price, or the settlement price, or the futures price actually. Imagine the quoted futures price is 102. Please, what I want you guys to understand is this is the price for the hypothetical 30-year bond that do not exist. So one last time. A bond futures contract is a futures contract on a 30-year bond. It could be a 20, right? I'm just giving an example. But this bond does not have to actually exist. However, when we quote the futures price, we will quote it on that bond even if it does not exist. This has implications. Because in real life, when the short side decides to actually deliver a bond, the 30-year bond does not exist. There are alternatives, for example, a 23-year bond, a 17-year bond, a 16-year bond, a 24, whatever. There are several bonds that can be delivered in satisfaction of that contract. But please stop for a second and think. I only pay you 102 if you deliver a 30-year bond. It's probably super unfair that I pay you 102 if you deliver this one, or maybe that one. It's unfair because sometimes you might be delivering a bond where I need to pay you more than 102. And sometimes you might be delivering a bond where I should pay you less. Why? Because the different coupon structures, different yield coupon structures make different bonds more or less valuable. And this is the role of the conversion factor. In front of every bond, guys, you will have a conversion factor. Please understand it once and for all. And that conversion factor is here to say one thing. And this is the simple formula, 3 letters, 4 letters. Once you understand it, you go back to your original formula, you never go wrong. I will only pay you QF if you give me the 30-year bond. If you give me any other bond, you see, other bond, I'll pay you QF adjusted by a conversion factor. If the other bond you're delivering is more valuable, then CF will be higher than 1. And if the other bond you're delivering is less valuable compared to the hypothetical 30-year bond that does not exist, then the conversion factor will be less than 1 and I'll pay you less. All right? So it all boils down really to this. You're not giving me the 30-year bond. I will not pay you the futures price. You will deliver another bond. I'll pay you the futures price adjusted by CF. Now, it happens in real life that the other bond is known. It can change, but it's known. We call it the cheapest to deliver bond. Why, guys? Put yourself in the short side's shoes. You have several bonds that you are allowed to deliver. You will deliver the cheapest to deliver. Notice that we do not call it cheaper. It's not the one that is the cheaper to buy. No, because the short side has to buy the bond and then give it to you. And you will pay QF times CF. The cheapest to deliver is the one that maximizes the difference for the short seller, for the short side. So the short side will pick the bond where when they buy that bond and deliver it to you, what you pay them minus what they paid to acquire that bond before delivering it to you is maximized if it's positive or minimized if it's negative. Please look at this equation. This one will actually save your life when you work with bond futures. Because all I want from you now is to isolate CTD. Right? Isolate QF, actually. The quoted futures price can very simply be rewritten as CTD divided by CF. Do you understand? So I'm going to pause for a second here, and I'm looking for a no. If you do understand, then we're fine. So did you understand what I explained, which resulted in me writing futures price equals CTD divided by CF? If we all understood this, then all I want to do now is to bring you back to the original formulas, right? Bring you back to the original formulas. Let me rewrite it. It would be much cleaner, right? So we said the number of futures. Let's use the duration alternative. It's the portfolio value divided by the futures price multiplied by the modified duration target minus the modified duration of the portfolio divided by the modified duration of the futures. Now stop please with me. Stop for a second and focus all your attention on this guy here, futures. That's the futures price. But this is the price of the futures on a bond that does not exist. We know that it's the CTD that will be paid, that will be delivered. please go back and look at this. Every time you see futures, you are allowed to replace it by CTD divided by CF. So come with me here and replace futures by CTD divided by CF. And here I pause for a second. One of the questions I got was, sometimes in the formula we divide by CF and sometimes we multiply. No, it's the same formula, except that it's your every right to actually use it like this, or you just recognize that A divided by B over C is equivalent to A divided by B multiplied by C, right? The C can go out and it becomes times, using numbers for those who are not very comfortable. So 100 divided by 20 over 4, right? The answer is 100 divided by 5, which is 20, correct? I'm saying that, of course, it's basic math. It's equivalent to 100 divided by 20 and then multiplied by 4. So the 4 can leave the denominator side of the denominator and becomes a multiple here, like in this case. So it's 100 divided by 20 times 4. So for the person who asked me about why is it sometimes dividing by CF and why is it multiplying by CF, no. If you divide by CF, then you're doing that. Or you're simply recognizing that you have the right to take the CF from the denominator of the denominator and it becomes a multiple. The two formulas are equivalent. It is not that sometimes we multiply and sometimes we divide. It is that you have the absolute right to use it as the denominator of a denominator, owing to the formula I derived here with you guys. And my aim is not to derive formula. My aim is to make sure that you guys understand what is a CTD and how does it link with the futures price. On a screen, you see a futures price, which is on a bond that doesn't exist. So you need to replace it with the bond that does actually exist, which is the CTD. And the relationship between the two is simply that F is equal to CTD divided by CF. So this is one acceptable version, and this is a second mathematically equivalent version. Now, of course, if you guys want to work with the BPV form of the formula, then the basis point value, then the number of futures to solve to increase or decrease duration is basis point value target minus basis point value portfolio divided by basis point value of the CTD. Remember, not of the futures. The bond doesn't exist, right? So basis point value of the CTD divided by CF. And one more time, it's your right to remove the divided by CF here and let the whole formula hit the CF conversion factor. So, how are you guys doing? Is it clear for everyone? Is everyone at ease with the concept of CTD, how to use futures to change duration? Excellent. One last word before we actually move to variance swaps and close. If there is any concept, because there are, we only have 3 hours, so there are concepts, of course, that I will not tackle, right? When I give these classes, like spread over hours and hours. So if there are concepts that I did not tackle here and that you guys would love to see tackled, then please make sure to ask. So of course we were working with durations. Let us work quickly with betas, right? Super easy. You have a portfolio of stocks. They have a beta P. You want to add futures. Each futures has a price of F and the beta BF. And you want to end up with the original exposure, but now with the beta of T. Solving for the number of futures, simply yields the very familiar form of our equation, P divided by F into target beta, portfolio beta, futures beta. All right? Of course, you will see cases, probably, you might see cases on the exam where you need to equitize. So you're starting with cash, then the actual BP is 0. The formula reduces to BT over BF. You might also want to completely hedge a stock position, so the target would become 0. So the formula reduces to negative BP divided by BF. The final thing that you need to make sure you are both aware and at ease with is rebalancing. So you might have 1 million invested in stocks with a beta of 1.6, and you wish to reallocate to 1 million in bonds with a duration of 6.2. Of course, it's a two-step approach, but you guys are equipped to do it. So first, you transform the stocks from stocks to cash, right? By bringing the beta of the stocks to 0. That would be your target. Now that you sold equity futures to change the stock position from stocks to cash, now you buy bond futures to actually increase the duration of cash from 0 to 6.2. Of course, if you're using bond futures, don't forget the conversion factor. All right? Excellent. Very good. I think we will move to fixed income, unless you guys... So I'm not tackling concepts on currencies unless you have a specific question, right? There's a third reading in derivatives. We have tackled the first two, options and then futures, forwards, and swaps. So if you have any question on the currency part, please ask. If not, we'll move to fixed income. Perfect. All right. So what do we have here? Several things, right, to populate this hour and a half that we have on fixed income. Again, reminding you as always, because I know that a lot of level 3 candidates would actually watch the recording later. But for those who are here, we can benefit from the fact that you can ask your questions. So what are we looking at here? So we look at immunization of single and multiple liabilities, really understand what it's all about, and also a neighbor concept of contingent immunization. We look at duration convexity, and then we look at the framework for expected return on fixed income. And from that simple framework, we'll move on to strategies, yield curve strategies and credit strategies for several scenarios. Scenarios being, as you guys know, static yield curves, divergent yield curves, parallel, slope twists, and curvature when it comes to benchmark yields. And then, of course, static and divergent for credit strategies when it comes to credit spread. I'll also touch a bit on the concept of duration times spread, right? What I'm doing is that I'm trying to come up with explanations on questions that I typically get when I give CFA Level 3 classes. So I have done this in Lebanon for a decade, and then I have done this with Wiley and then UWorld, where I used to teach all 10 topics of the CFA Level 3 exams. So typically the questions that were actually on problematic topics, right? We did not cover, by the way, variance swaps. So if we have like time remaining, I will also tackle a bit on that, put some like just making sure that you guys would use the right given on the exam, right? Like notional variance and not sigma, notional of sigma, all right? Or volatility notional. Good. So fixed income. Let's start with the simple framework. because I also got a question there regarding the expected return of fixed income securities. Because by walking through that framework, I think that I would probably answer several questions. So when we look at the fixed income portfolio, what are the components of expected return? How will we make money? What will be the sources of gains, but by the way, also losses on a fixed income portfolio? This is interesting not only for CFA Level 3 candidates, but for any investor, especially in this particular period where interest rates are expected to start normalizing downwards. So there are a lot of duration plays, right, over the coming period that could be very interesting. So expected return on a fixed income portfolio. When you buy bonds, these are the different sources of gains and losses. Let's write them down. Coupon income. Roll down yield. Together, of course, we call them the rolling yield, right? And then you have the change in price of the bond for given changes in benchmark yields. More on this. And then you have the expected change in price of the bond for changes in credit spreads. And then you have potential gains and losses because of currency changes if you're buying bonds in different currencies, right? And you also typically have expected losses, which is the probability of default times the loss given default inside that portfolio. And it's typically in negative. Whereas FX, delta price can be both positive or negative. All right? So let's look at one by one, because this is actually the menu for the fixed income part. We will touch on each of these points, and by doing that, we will say, okay, wait, so now I'll make sure that everybody understands credit spread duration. Now I'll make sure that everybody understands DTS. Now we'll look at strategies, how to do that, etc., etc. So this is really the actual menu for what's coming. Anything you can think of in fixed income level 3 exists somewhere in this, on this simple slide. Coupon income. Make sure you do understand that this is simply the income that you earn annually divided by the price you paid to acquire the bond portfolio. So it is really the current yield, something that you know from level 1, right? It's only the current yield portion. It does not factor in what you gain or lose because of pull to par. It's just the coupon divided by the price you paid to acquire the bond portfolio. So if you assume no reinvestment of the coupon, that's simply coupon divided by price. What is the roll down yield? I typically get questions, and I got a question actually for this session on this one here. The roll down yield is actually how the bond price would change without a change in the benchmark yield curve or the credit spread. So first, I'll be using the terminology benchmark yield curve and spread. So I have to remind everyone, of course, that's a level 3 session, so everybody knows very, very well, that when you buy a bond, the yield that is promised to you is actually composed of the risk-free rate and a credit spread. Of course, inside that credit spread, you have a liquidity compensation for liquidity risk, you have a compensation for credit risk, and you have a compensation for what we call credit premium on top of the expected PD and LGD. This is how your yield is actually composed. Now, your yield can change hereby changing the price of the bond because of changes in the risk-free rate. So the bond itself is not riskier or safer. The credit spread did not move. It's just the risk-free rate that goes up or down, right? Because of different reasons, as you know. And all bonds will actually be impacted by this, and all yields will actually change. All right? So the credit spread on the other side relates to the extra compensation that investors require because of this particular bond, also embedded the credit quality, etc. But let's focus on the big picture. So if the issuer becomes riskier, then the credit spread will widen. If the issuer becomes safer than or less risky, the perception of the market is that the issuer is less risky, then the credit spread would actually go down. All right? So when we say the yield can change because of benchmark yield changes or because of credit spreads, both of these will actually change the yield and the bond will gain or lose value. And by the way, this is a whole reading in your fixed income curriculum on the gains or losses because of changes in the benchmark yield, which is simply this guy here. While this reading, the change in price because of changes in credit spreads and what are the strategies that we can pursue, is because of changes of this guy here. All right? Also, to make sure that everybody is on the same page, duration approximates the change in the bond price for a 1% change in the yield that comes from the benchmark. I know that many might think, why do I care whether the +1 came from here or it came from there? In both cases, the yield will go up by 1% and the bond will fall. Correct, but not always. First, the benchmark bonds, i.e. the risk-free bonds, do not have credit spreads. So the concept of credit spread duration is not relevant to them. Second, you have floating rate bonds. Imagine a 10-year floating rate bond repriced every year. From an interest rate perspective, it has a 1-year duration. It responds to the 1-year risk-free rate. Whereas from a credit perspective, it has a risk of 10-year, right? It's a 10-year risk. So the spread duration is close to 10, while the yield, the benchmark yield duration, is closer to 1. So it's not true that duration and spread duration are always equivalent. For sovereign bonds and for floating rate bonds, bonds that have a different repricing schedules, they are not the same. That said, duration only approximates the change, as you know, so you need the convexity adjustment, right? So also making sure that everybody is on the same page before we can jump in. This is what actually happens to the price. That's the real price yield profile. If you start with the yield here, you have a price there. Now, if the yield goes up by 1%, the price will fall to this point. While if the yield goes down by 1%, the price will go up here. As you guys know, the price will go up more when the yield goes down versus the extent to which the price will drop when the yield goes up. A very similar analogy to the theta analogy I used earlier can be employed. Think about it. When the yield is already at 3%, every 1% that it falls is 1/3. When the yield is already at 11% and it falls by 1%, that's not a lot. This is why you see much less sensitivity at high yields environments and much higher sensitivity at low yield environments, hence a higher duration. The problem with duration is that it lives in a linear world, right? It's a first order approximation. It's a line that is trying to tell you what happens to the bond when the yield changes. Being a line, it will tell you that the bond will go up or down by the same magnitude when the yield goes up or down. In reality, life is not linear for a bond price. It's a curve, and duration is only a good approximation. Duration is only a good approximation for small changes in yield. Look how for small changes in yield, reality, which is the curve, is very close to the estimate, which is duration. That's duration. That's reality. So for very small changes, the approximation is fine. For larger changes, note how there is a large departure between reality and estimation. And of course, to adjust for that departure, you need to add convexity. Everyone should be familiar with this formula. The change in percentage of the price is negative D times delta Y, negative because the price and yield move in an opposite way, plus half the convexity times delta Y squared. This is a formula that you need to know, because whether the yield changed because of benchmark rates or because of spread durations, this formula would work, except that here you would use yield duration and convexity for changes in RF, risk-free rate, while if the change is one of the credit spread, then you would use credit duration and credit convexity. They will be equal if the bond is not a sovereign one and not a floating rate bond, at least theoretically, right? Not necessarily empirically. So you need to, of course, know this formula, right? Now, where does this formula come from? Also, it also helps because I want to make sure, and it's very important for the exam, that we don't memorize formulas, right? This is a Taylor series expansion applied to bond pricing, right? Because at the end of the day, think about it. You're trying to approximate the behavior of an animal that has a curved behavior with a duration that believes that life is linear, which is not correct. Look at this quick and simple example. Y equals x squared, right? Let's invest a minute. It's always nice when you understand where are your formulas coming from, especially those with a non-math background. Don't worry, it's very basic math, right? So y is equal to x squared. Now, let's take x and y. If x is 1, y is 1. If x is 2, then y is 4. If x is 3, y is 9. If x is 4, y is 16. If x is 5, what is the value of y? Of course, you might say, very easy, it's 25. Yes, but imagine it was a much, much more complex number. That's why we use derivatives, calculus, right? Not options. Derivatives as in calculus. So a good way to approximate the change in y for a 1 unit change in x is to calculate the first derivative of that function, which is 2x. You're standing at the point 4, so 2x is 8, guys, correct? This is like duration. This is a linear estimate for something that is non-linear. And as duration is inaccurate, you'll see how this is also inaccurate. So this means that for every 1 unit change in x, from 4 to 5, y should change by 8. So I take 16 and I add 8, and naturally I obtain 24 and not 25. Why? Because I'm trying to understand the behavior of a non-linear function using linearity. Guys, that's exactly what duration is doing. Duration cannot come up with the correct change in price because it's trying to capture a non-linear behavior using a linear tool. Hence, second derivatives. What is the second derivative of this function? 2. It's a constant, right? Because the derivative of 2x is 2. Now listen. To compute the actual change in y using the Taylor series expansion, that's what you'll do. You'll say, for every change in x, I'm going to multiply it by 8, and then I'm going to take half of the second derivative and multiply it by delta x squared. Let's see if this gets us to our actual result. So delta x moved by 1. 8 times 1 is 8. Continue. 1 half of 2, which is 1, multiplied by 1 square gives me 1. 8 plus 1 gives me 9. I add 9 to 16, and I obtain 25. the exact result. I want you to stop for a second and notice the similarity between this and this. Convince yourselves that duration is the first derivative and convexity is the second derivative. And no one woke up one day and said, you know what, we'll do this. No, it's just a Taylor series expansion of how the first and the second derivatives are actually needed for a nonlinear, for a second order function, right? And then putting them all together. So that's 1/2 convexity times delta y squared. 1/2 second derivative times the change in the independent variable squared. From that, you guys should also capture the idea that convexity is still not enough. Although we typically stop at that point, we don't calculate a third order derivative. But the valuation of a bond is not a second order function. So typically, you would need third, fourth, but they are negligible. So we stop at them. So please make sure that this formula is actually well understood. All right? Very good. So now that I'm sure that everybody knows the basics and we are all well equipped, what is the roll down yield? As you know, there is a pull to par concept. Any bond that trades at a premium will slowly converge to par as time passes. And any bond trading at a discount will do the opposite. So that's a bond trading at a premium. If nothing changes, the yield does not change, then the bond will slowly go down to par, and at maturity, the bond will be worth par. If the bond starts at a discount, it will be pulled to par. You only have to take a calculator and just keep discounting cash flows, one last cash flow at a time, until you arrive at maturity where the bond is actually worth its par value. But roll down yield is not only that. Because when the yield curve does not change, there is something that can happen beyond just pull to par, especially if the bond doesn't mature. So please look here with me. Imagine this is your yield curve. All right? So just to make things very simple, so the 1 year yield is 2, the 2 year yield is 3, and the 3 year yield is 3.5. So I should have written here 1, 2, 3, 2, 3, 3.5. All right? Now look, guys, I want you to buy a 3-year bond. Let's say it's a 0 coupon bond. The price today is par value discounted by 1 plus 3.5 power of 3. Let me know if you don't agree or if you don't understand the idea. So the price of this 3-year 0 coupon bond is given by that. Now, all I want you to recognize is 1 year later, this is no longer a 3-year 0 coupon bond. This is a 2-year 0 coupon bond. And this is where the trick is. Despite, I might even say, because of the fact that the yield curve did not change, then this 3-year bond is now a 2-year bond. And because the yield curve did not change, then the yield on that bond is now 3%, guys. So the bond is now valued as 100 divided by 1 plus 3, not 3.5, power of 2. So in addition to the pull to par, there has also been a price appreciation that came from the fact that despite, even because of the fact that the yield curve did not change and it is upward sloping, with the passage of time, the bond is rolling down the yield curve. So it is now trading at a lower yield, hence a higher price. This higher price is actually captured in the roll down yield, in addition to the pull to par. Why? Because the yield curve did not change. I will not say, okay, wait, then the yield of the bond changed from 3.5 to 3. Hence, it should occur here, in this one. No, that's really a change in yield. Actually, the curriculum would decide where it should fall, but in the way it is written, the understanding is that the roll down yield relates to the pull to par, but also, as I explained, the fact that as time passes, especially if the yield curve is upward sloping, then the bond is approaching maturity, and by that trading at successively lower yields, which means higher prices. Of course, if the yield curve was inverted, then the opposite would have happened. These are captured in the roll down yield. When you add these two, you actually get the rolling yield on the bond. All right? Perfect. So these two are the first two components of our framework. Now, we move to the change in price of benchmark yields and strategies at the same time. If you agree with a static yield curve, then do exactly what I just described. Ride the yield curve. Imagine you have a time horizon of 1 year. So you want to buy a bond, and in 1 year time, you need your money, right? If you believe that the yield curve will remain static, then do exactly what I just did a couple of minutes ago. Ride the yield curve. Go and buy a bond with a maturity or a duration that extends above 1 year. By doing that, you will win two things. If the yield curve is upward sloping, one, you'll earn a higher coupon. Because by buying a 2-year bond instead of a 1-year bond, you'll earn a higher coupon. Two, because the yield curve is upward sloping, the 2-year bond you bought, 1 year from now, it will become a 1-year bond. So it will trade at a lower yield, hence capital appreciation. Bottom line, if the yield curve remains static, i.e. doesn't move, then you make more money by investing in a 2-year bond if your time horizon is 1 year, rather than buying a 1-year bond to match your horizon. All right? So on the exam, this is a very important idea. If you believe the yield curve will be static, ride the yield curve, do a carry trade, use derivatives to extend the duration, anything that will actually make you benefit from a longer horizon means a higher coupon with a potential capital appreciation when the bond rolls down the yield curve without losses, because you believe the yield curve will remain static. Of course, if the yield curve shifts up, then you will lose a lot of money. So this strategy works when you believe the yield curve will be static. Now, what if you believe the yield curve will you have a divergent yield curve expectation? You believe the yield curve will actually change. And here, to be able to answer, you need to think, what is the actual scenario we're looking at? So we are trying to review concepts together here. Make sure that you are fit and you are completely at ease with these. How can the yield curve change? There could be a change in the level, there could be a change in the slope, or there could be a change in the curvature. I'm starting with level, the simplest. If you expect the yield curve to go up parallel, reduce the duration of your portfolio so that you minimize the loss. If you expect the yield curve to go down parallel, increase the duration of your portfolio so that you earn more. So for the parallel up and down, it's really simple. Now, what if the change is in the slope, a twist of the yield curve? Here, it's important to invest a couple of minutes. If this is the original yield curve, if you expect a steepening of the curve, then you also need to check how do you expect the curve to steepen. And please make sure to read well on the exam. I'm not going to talk about exam strategies here. There is a video on YouTube that is posted by the CFA Society of Hong Kong, right? A session that I did with them on explaining strategies, how to write, how to read, etc. So you can always, for those who need, you can always check it online. So with the CFA Society of Hong Kong, right? But you need to read carefully, how do you expect the curve to steepen? If you simply expect it to steepen because short-term rates will go down and long-term rates will go up, then the best strategy is to actually construct a duration-neutral portfolio where you go long the short-term bond and you go short the long-term bond. You will win both ways, right? When the curve steepens, because the short-term rates go down, remember you are long a short-term bond, it goes up. You are short the long-term bond, so when the yield curve goes up on the long end, the bond would lose big time. But since you are short, then you make money. You'll make money on both sides of the transaction. So it's a barbell portfolio, but where one is long and one is short. Of course, you do want to make duration neutral, because what could happen is there could be a parallel shift. And if a parallel shift happens up or down, you are hedged, right? Because the net duration of the portfolio, so you solve for the weight in the bond that you buy here and the weight on the bond that you short here, which is much smaller, of course, for the net duration to actually be zero. Because you don't have a view whether the steepening will happen with the curve increasing or decreasing. You don't have that view. You are simply betting on a view that the curve would steepen because short-term rates would go down and long-term rates will go up. Neutral duration, long the short-term bond, short the long-term bond. Duration is neutral because you want to hedge against, instead of a steepening happening, a parallel shift happening up or down. All right? But that's not all. What could actually complicate the process is that typically the curve could steepen or, of course, flatten while going up or down. So while going up or down, the curve could steepen or flatten. We call it a bear steepener when the curve shifts up in general and becomes steeper. As you can see, bear, because of course when rates go up, they have a negative impact on bonds. So it's a bear steepener, right? Both up and a steepening of the slope of that curve. Now, what happens here is that you don't want to be duration neutral because you are expecting the curve to shift up. Unlike in my previous example, where it was just the end and the short rate, the long and the short rate, one goes up, one goes down. Here you expect an overall up move of the curve and the steepening. Again, you want to go long and short, but this time you want to keep a net negative duration. These are very important to understand on the exam in case of qualitative questions without numbers. Of course, you're going to go long this bond and short this bond, but you don't want the net duration to be positive. All right? You want to have a negative net duration because even if the curve doesn't steepen as much as you want, remember that it went up. So by having a portfolio with a negative duration, You make money when interest rates go up, instead of losing money like what bonds would actually behave. So you want to have a net negative duration because you expect the overall to actually be an increase in the yield curve. Of course, for completeness, the steepening can be a bull steepening of the yield curve. There could be a bull steepening of the yield curve where the whole curve goes down but steepens. And this happens when long-term rates fall by less than short-term rates. Contrary to what happened earlier, for the bear steepener, long-term rates went up more compared to short-term rates, but they all went up. This is called a bull steepener. One more time, you're going to go long or short either end of the barbell, but you want to position yourself with the net positive duration, because you know that there will be an overall movement down, so you want your net position to have a positive duration, so that if the change is parallel down instead of steepening, you end up making money. Of course, on the exam, know that the worst case scenario is always the fact, or always the case, where what happens is opposite of your expectation. If you expect a bull steepener and then you have a bear steepener, or a bull flattener, let's say, then it's exactly the opposite of what you wanted to happen. Then you will have losses. The same ideas would work for bear changes of the yield curve. Moving on to changes in the curvature. So we know how to position ourselves for static yield curves, changes in the level parallel up or down of the yield curve, changes to the slope of the yield curve. And remember, of course, I'm not opening these discussions, but why would the slope of the yield curve change? Like in our previous example. This, for example, could be the central bank cutting very drastically short-term interest rates to stimulate the economy. So when this happens, the yield curve will actually see a bull steepener, right? Because the short end of the curve will fall drastically, while the long end of the curve would actually fall very little potentially, right? Or even it might not fall, but you will have a bull steepener. So what about curvature? The third way, or the third change in the curve that we might anticipate and want to position ourselves against, is a change in curvature. Many things you need to know. First, you need to know that the curvature of the yield curve is due to the fact that usually the difference between short and medium term rates is much larger than the difference between medium and long-term rates. This is mathematically what actually drives that curvature. Now, the larger that difference, the more or less pronounced the curve will be. So how do we calculate the curvature of this yield curve? We take twice the mid-rate minus the sum of the short and the long-term rate. Now, because the medium rate is more distant from the short rate compared to the medium rate and the long rate, this will typically be positive. Most of the time, the curvature of the yield curve will be positive, depicting something like this. Rarely it will be negative, especially to be negative, typically you need to have some inversion, or what you would call here, it will become like a saucer, right? This is where twice the medium rate minus the short and the long rate becomes a negative amount. So the first thing you need to know is, how do we capture the curvature? We measure it by twice the mid rate minus the sum of the short and the long-term rate. One common confusion, please pay attention to it. When the curve becomes more curved, i.e. this value goes up, we call it a negative butterfly shift, right? So make sure you remember that. When the curvature becomes more pronounced, i.e. if this had a value of 2 and it becomes now 2.2, you now have more curvature. However, we call it negative butterfly shift. When the curvature becomes less pronounced, i.e. this number falls from 2 to 1.9, let's say, it's a positive butterfly shift. How do we position ourselves when we have expectations on the curvature actually changing? It's typically a combination of buying or selling the head or the body and doing the opposite with the wings. So this is the short end of the wing, this is the long end of the wing. So let me explain. If you believe that there will be more curvature because the medium term rate will go up significantly, while the short and long term rate will go up by a little, then your curve is even more curved, right? The curvature is more pronounced. Then what you want to do is to actually short the body, because you will have the largest change in the rate here, and because of the duration here, you will have a gain because you're short the body. The bond will fall drastically, you make money, and you would go long the barbell. And contrast this with the barbell in the previous section on the slope, where the barbell itself was a long-short play. Here, the barbell, you go long or short, both ends. So in that case, you go short the 10-year bond, and you go long the 2-year and the 30-year or the 20-year bond. For any opposite, of course, expectation, then you would do the opposite. All right? When it comes to credit strategies, make sure that you recognize that many different spread measures exist. So on the exam, you need to be able to calculate, discuss, etc., all these types of spreads, starting with the nominal, simply the difference between the yield of your bond and the yield of the closest benchmark bond, super inaccurate. G spread, the yield of your bond versus an interpolated yield of benchmark securities, more accurate. But of course, the G spread has many deficiencies, doesn't account for optionality, right? Doesn't account for the shape of the yield curve, because you are using one yield figure to characterize a bond. It doesn't take into account the spot rates below that yield level. Moving on to I spread, which is the spread between the yield of the bond and an interpolated spread of swaps, interpolated swap rates, right? Advantage is more points, less need to interpolate, etc. An asset swap spread, very close to the I spread, except that the asset swap spread, the only one, is the difference between the coupon of your bond and the interpolated swap rate, not the yield. So you might tell me, but if the bond trades at par, then these two will be equal. My answer is yes. You have the Z spread, which is the first attempt at capturing the shape of the yield curve. Let me explain quickly. If you have a 5-year bond with a yield of 6%, and you have a 5-year risk-free bond with a rate of 4, you say the spread is 2. The problem is, although this 5-year bond has a yield of 6, remember that the yield is an average measure. In reality, there is a curve for that issuer where the 1-year yield is something, the 2-year yield is something else, up to the 5-year yield. These measures are only taking one figure on that curve and comparing it to the comparable figure on the benchmark curve. But whatever happens before that point, whether this or this or this or this, is not actually captured. So the Z spread, as you guys know, captures the shape of the curve because you do this. You have the price of the bond, equal to the cash flow discounted at 1 plus the treasury spot rate for that maturity, plus the Z spread. And you actually do that for all the cash flows. And you're solving for the Z spread, which if added to every point on the spot rate curve would actually make the price of the bond equal to its market value. Meaning that you are taking into account the shape of the spot curve before arriving at the final yield. And finally, option adjusted spread. The problem with the Z spread is that it does not account for optionality. For example, the Z spread on a callable bond is 4%. You cannot know how much of the 4% is for credit risk and how much is because you sold a call. When you buy a callable bond, you have sold the call option. If the callable bond has a Z spread of 4%, so it's giving you 4% more than the treasury, you cannot know how much of the 4% is a compensation against the credit risk of that bond and how much is because you're selling a call option to the issuer. Enters OAS. The option adjusted spread factors in the optionality, removes it, and only shows you the compensation for credit risk. So it is the only one that is appropriate for bonds with embedded options. The big problem with the OAS is, remember level 2, guys, binomial model to value options. The OAS is the spread which, if added to every rate on every node of the tree, right, would give you the price of the bond equal to its price in the market. So it relies on very, very heavy assumptions. So in real life, it's like almost impossible that you will actually realize the promised OAS. Because for the OAS to materialize, all your assumptions regarding volatility, etc., in the future should prove to be correct. However, it is the most advanced of them all, and it is superior to them all because it's the only one that can work for bonds with optionality. All right? You stop me if anything here is not making sense. So, credit strategies. Credit strategies. What we're doing here is that we are now trying to capitalize on changes in CS, the credit spread curve. So before I start, I need to make sure that everybody has a good practical understanding of what the credit spread curve is. For a given issuer or a given credit quality, it shows me for different maturities how much credit spread I'm getting. So a 1-year bond is getting me a credit spread of X. A 2-year bond is getting me a credit spread of Y. This is a credit spread curve. It's not the yield curve. This one is about the risk-free rate. We are now discussing strategies for when you expect the credit spread to actually change, the credit spread curve to actually change. Before we do that, it is of really high importance that you understand that there is a one-size-fits-all concept when the risk-free rate changes that is absolutely not applicable to credit spread changes. Why? Because when the risk-free rate changes, it changes the same for everyone. Hence, it makes sense and it's conceptually correct to say, let's simulate a 1% change in interest rates. I don't think it's conceptually sound to say, let's simulate a 1% up parallel change in credit spreads. Because if AAA rated bonds see their credit spreads go up by 1%, chances are B bonds will see their credit spreads go up by like 7%. So the concept, please understand that point. This is the point that will justify in your mind the existence of DTS, duration times spread. Spread parallel changes in the credit spread curves is not something coherent or conceptually correct. This is why, one last time, it makes perfect sense to say, what if benchmark rates went up or down parallel 1% or 2%? It will affect all bonds everywhere in that market the same. When I say the same, some disclaimers, because I need to investigate the reasons behind the changes in the risk-free asset, because they could be linked to potential deterioration in the economy, which itself has an impact on CS. So things in reality are trickier, hence the concept of empirical duration. Empirical duration exists to say, guys, when the risk-free rate goes down by 1%, it's typically because the central bank is lowering the rate to stimulate the economy because we are in a recession. So chances are there's a high probability that when the risk-free rate goes down by 2%, chances are credit spreads are widening. So in reality, the risk-free rate is dropping, but the CS is going up for some bonds. So in reality, the duration, the bond will not react as you might expect it to react, i.e. 2% times its duration. It won't react like that. One more time, because when the risk-free rate goes down by 2, it might be the case that the CS is going up, canceling part of the total drop in the yield. Hence the concept of empirical duration. Now, leaving that aside, credit spread changes are not equal for everyone. They are rather approximately proportional to the original spread level, i.e., if bond 1 has an existing credit spread of 1% and bond 2 has an existing credit spread of 4%, typically, for every 1 basis point that bond 1 spread will widen, bond 2 spread will widen by 4 times that. The actual levels of the credit spread typically dictate the proportionality of the response for credit spread changes for these two bonds. It's a very, very important conclusion. You cannot say in real life, what if credit spreads went up parallel 1%? Because if they go up 1% for bond 1, it means that they will probably go up 4% for bond 2. Hence the concept, and please understand it, of duration times spread. So imagine these two bonds, guys, have the same duration, 3, for both. Both of them have a duration of 3, spread duration, meaning that when the spread goes up by 1%, both bonds theoretically should lose 3, except that when the spread for bond 1 goes up by 1, bond 1 will lose 3, the spread on bond 2 will go up by 4. So the bond will lose 12. Very simply, duration times spread multiplies duration by the existing level of the spread. 3 for bond 1, 12 for bond 2, 12 for bond 2. Meaning, for every one basis point change in the credit spread of bond 1 will see its price change by 3 basis points. However, we need to know that when the credit spread of bond 1 changes by 1 basis point, probably the change on bond 2 will be 4 basis points. So you can simply multiply the 1 by 12 and it already do the math for you. The correct sentence would be the following. For every 1% change, for every 1 basis point change in the spread of bond 1, Bond 1 will see its price change by 3 basis points. Bond 2 will see its price change by 12 basis points. The underlying idea being that yes, for a 1 basis point change in the spread of bond 1, there is a 4 basis point change in the spread of bond 2. Is duration times spread understood by everyone? Of course, looking for a no in case it's not. If you're fine, then moving on. Excellent. So we come back to, if I bring you back to this slide, so we have covered coupon income, roll down yield. We have seen both ideas. We've seen riding the yield curve for static yield curve changes. We've seen for divergent expectations. Now we're looking at this. So what do we do if we believe the credit spread curve will change? First, before I answer and we close the fixed income part here, we just tackle immunization maybe. Let me tell you that the credit spread curves are very, very much explained by the economic cycle, the business, the credit cycle, right? If you remember from level 3, from other also capital market expectations, you see the economy in recession, in recovery, in, let's say, early expansion, which we can also call recovery, and then late expansion or peak, right? So let's use here peak so as we simplify the analysis. I have 2 pieces of advice for you guys for the exam. Maybe the most confusing thing that anyone can do when they're trying to analyze the impact of the cycle on anything is to unfortunately forget that the cycle has no starting point and ending point. You must always make sure to tell your brain, right, to tell yourself that if you're looking now to analyze what you have in a recession, you must always tell yourself, okay, so I'm in a recession, which means that I was earlier at a peak. Because life does not start at a recession or a recovery or an expansion or a peak. It doesn't start, it doesn't end. It's a cycle. So wherever you put yourself on the cycle, please remember what existed before that point so that you can analyze further. I'm talking about now the slope and level of credit spread curves. Let's start with the recession. This is what I tell my mind, guys. So maturity, credit spread. Again, this is how I would look at it. If I'm in a recession, then I am in a place where the defaults are at their peak. Companies are starting to default or actually continuing to default, right? I'm in the midst of a recession. The next couple of months or years are looking horrible. But I know that at some point the recession will end. Unless, guys, you lose complete faith in the economy that you are dealing with. I always say it in class. I'm really sorry about that. But what I don't like is when we study without looking at it practically, we learn concepts such as short-term rates are more aggressive than long-term rates because inflation every year will go up and down, right? But the long term is an average. So as long as inflation, think about it this way. If inflation next year is 1, then 2, whatever 1 and 2 means, right? Quantities, larger quantities, then even worse, and then even really worse. But then after that, 3, 2, 1. If it goes up, and then down, then the 20-year average will actually stay the same. Yes, but only as long as you stay within 1 to 4. If at any point people start to think that after 4 there will come 5, 6, 7, 8, 9, then the long-term average will start to move. So practically speaking, when we say that the currency that pays a higher interest will actually drop All of these you need to analyze practically. It's not how life goes, right? However, this would work here. You are in a recession. The actual levels of default are very high. For someone to loan money now, they require a very high spread. So I say spreads are very high for the short run. However, we know that, of course, if we have faith that the central bank, the economy, and the recession is not structural, it's not a country that is at war, it's not a country that went completely bankrupt, it's not a country that lost its reserves, whatever. So if we know that this is normal up and down, then we know that the future is brighter, right? We are in the middle of a recession. The credit spreads are very high for the short run. We're very scared for the next year or two, but we know that after that, a recovery will actually emerge. So for longer maturities, we will require a lower credit spread. And the spread curve will actually be inverted. So when you are in a recession, you can see the curve that is, right? I could have started from anywhere. It's wrong to start from somewhere. You can start from anywhere and then link them. So starting from a recession, please be aware, or please be ready to do this kind of analysis. The short-term credit spread levels are high, but the future looks brighter on the longer run because you will emerge from that recession. So you will see people asking a higher compensation for shorter term bonds, and for longer term bonds, factoring the fact that things will become better. Now you are in the recovery phase. Things will not get worse. So probably defaults are at their peak. That's it, right? Recovery starts at the trough. So things are bad, worst, horrible, catastrophic, and then they stop being worse. They are still negative. It's still very bad, but they stop being worse. So probably defaults are at their peak. People are still nervous. Did we emerge yet? Is it a very short-term correction, or the recession will come back again? Of course, the short-term spreads will remain high, but they have peaked. And the curve will typically be I'm talking, by the way, about high-yield bonds, because investment-grade bonds are less sensitive. They are okay, typically, in all scenarios. A AAA rated bond is fine in recessions, depressions, and expansions, typically. So they are less sensitive. The moves are much, much less pronounced. For high-yield bonds, that's what's happening. So the credit spreads are now at their highest point. The curve is very much inverted, capturing the fact that tomorrow is actually better. Now you are in an expansion. Profits are now positive. No defaults. Cash flow is abundant. All companies are doing well. Short-term risk is low. Of course, the short-term credit spreads will drop. The actual level will be lower than what it was earlier. And the spread curve will start to flatten. It was inverted. It starts to flatten. You are now approaching the peak, right? Defaults are at their lowest ever. Short-term risk, or before you approach the peak, short-term risk is at its lowest. However, people are starting to worry about a potential recession. Remember, it's a cycle. So the yield curve will now steepen, factoring in the fact that today we're fine, but the future, remember, the slope shows me the expectations. But the future, of course, we are factoring in a potential recession. So the curve will drop and steepen. You start approaching the peak. Now you have over leverage. Companies are over indebted. Any shock in the market would precipitate you in a recession, where automatically the short-term risk would go up and the yield curve would start to flatten, then invert before a recovery, and then the cycle repeats. So simple but important links to be able to draw. What do we do when we have a static view regarding credit spreads? Exactly like we did for benchmark yields. Increase the duration, decrease the credit quality of your portfolio. Example, if you normally buy A-rated bonds, buy BB rated bonds. Because if the credit curve remains stable, by buying BB bonds, you get a higher coupon. When time passes, there will not be more defaults or the curve will not change. So you would have earned a higher return, but for the same level, if you want, of defaults and with no changes in the credit curve. If you think that the credit curve will be static, increase the spread duration to roll down the yield curve, right? Think about it. If the credit spread curve is upward sloping, buy a 3-year bond, guys. It will get you a larger spread. Now wait 1 year. 1 year later, this 3-year bond is now a 2-year bond. So it now commands a lower credit spread. Yield will fall, price will inflate. Exactly same concept as for the benchmark yields, right? So make sure you understand that. Lengthen, increase the spread duration of your portfolio. Also lower the credit quality, because by lowering the credit quality, remember, duration times spread, it inflates. You have a larger duration times spread. All right? So same strategy. And of course, for the sake of time, I'm not diving into the ideas that to increase duration, you can do it with derivatives. When you buy futures on bonds, you increase duration. When you enter a swap as the receive fixed pay floating, you increase duration, right? So there are many ways to increase duration. What do you do if you think the yield curve, the credit spread curve will actually change? Then it all depends on how you see it change. If you think that the yield curve, the credit spread curve, will actually flatten. So for example, you will have this, an increase in short-term credit spreads and a decrease in long-term credit spreads. You would buy a 1-year credit default swap. So as when spreads go up, credit spreads go up, you make money on the swap. And you sell a credit default swap, a 5-year or 10-year credit default swap, so that when the long-term CS go down, the credit default swap price goes down. Since you shorted it, you make money. So the ideas here are simpler to think about, maybe harder to calculate, but much simpler to think about. Based on how you see the credit spread curve changing, you would actually use credit derivatives to make sure that you would profit from that change. You might implement a credit default swap curve trade on the same issuer. If you expect that an issuer will have short-term issues, but then after this period is gone, then you would have a normal, stable period. Then you would only buy credit default swaps on the short run because there is a payment coming soon, there is uncertainty soon, and then you would sell a long-term credit default swap. So be ready to just read how the credit spread curve is expected to change and how to actually implement a CDS trade, or like I did earlier for a static curve, to profit from that expectation. Any questions on this part? All right. I'll keep 10 or 15 minutes for currency management later, right? What I'll be doing now is just discuss a bit immunization, right? Make sure that you guys understand it in the right way, and also be able to answer potentially qualitative questions, because they are more difficult than quantitative questions. These are the ones that are typically designed to make sure that you understood the concept rather than memorizing it. All right? Pausing for 15 seconds, just so that you guys, all right, checking if there are questions. All right, perfect. Okay, so I think these were discussed appropriately. All right. So I know 3 hours is a long time, of course. So there are some parts that you can watch again. So let's just use some of the remaining time to discuss quickly immunization and maybe only the most important concepts in currency management. So when you immunize against a single liability, you have three conditions that you need to be well aware of. And my aim is just to make sure you understand how these conditions were actually created. So if you have a 10-year liability, it has a 10-year Macaulay duration. First of all, you need to remember that. It's a 10-year zero coupon liability. The best way to immunize is for the present value of assets to be equal to the present value of liabilities. You need the Macaulay durations to be equal. And you need to minimize the convexity of the asset portfolio. And I think that this part is the one that is the most problematic, because from questions that I typically get, I know that convexity is something that is quite tricky. Convexity is something that is very useful when you expect yield volatility, because convexity is expensive, right? Remember that it is expensive because the more convex the bond, the more it gains when rates go down, and the less it loses when rates go up. It's a benefit. So typically bonds that are more convex trade at a higher price because they are sought after, and because convexity represents an advantage and you have to pay for that advantage, so the yield is lower. Very, very important elements to remember is that a zero coupon bond has a Macaulay duration equal to its maturity, of course. Macaulay duration changes proportionately to maturity. So for example, a 10-year zero coupon bond has double the duration when compared to a 5-year zero coupon bond. For convexity, it moves with the square of maturity. So a 10-year zero coupon bond has approximately 4 times more convexity than a 5-year zero coupon bond. So also things to information knowledge to have before moving on. This 10-year liability has a 10-year Macaulay duration. I think that this part of the curriculum, even though the conditions are simple, is one that is the least well understood sometimes. Why do I want the Macaulay duration of my assets to be equal to the Macaulay duration of my liabilities? For a very simple reason, that the Macaulay duration of my assets is the period for which, even if interest rates have changed, I would still earn my promised yield. So I would stabilize the yield that I'm earning. Let's take a 10-year liability of 100 million with a yield of 5. So to immunize it, I'm going to go, the present value today, let's say, is 100. No, not the present value. So the present value is much lower, right? It's 100 million divided by 1 plus 5, power of 10. Let's say the present value is 60 million. It's a wrong figure, just so that you and I use it. So ideally, we want to go buy an asset today for 60 million, right? We want to minimize the cash outlay today because we want to try to immunize the liability with the least possible amount of money. Now, mathematically, guys, even if they don't say it, the only way 60 million of assets will reach 100 million in 10 years, exactly like the liability will do, is for the yield on the assets to be higher than 5%, right? It's like a race. Think of it as a race. So this is the finish line. This is the liability today. This is the asset today. They have the same value today, right? That's the finish line. They have the same value today, 60 million. But the liabilities are growing at 5% per annum. That's the speed. Imagine two sprinters, and that's the speed for liability. Of course, if assets are starting at the same value and you want them to reach the finish line at the same time and be worth 100 million, then assets should also grow at least at 5%, if not a little bit more. So obviously, the first condition is simple: have enough money and make sure that they grow at the same speed at least, or even a bit more. Now, why the Macaulay duration has to be equal to the Macaulay duration of the liabilities? It really has to do with the Macaulay duration of the assets. Remember that the Macaulay duration of the liability is actually the maturity, which is 10. So basically, it's like saying, make sure that the Macaulay duration of your assets is equal to your investment horizon. Why? This is why. This is maturity. This is par value. Imagine the bond is here. Now imagine, guys, for a second that interest rates went up sharply. The bond drops. But if you leave it to maturity, that's maturity, it will reach par. Now, of course, it's a double-edged sword, because when interest rates go up, there's a bad effect. Unhappy, you lost money. However, there's a positive effect. You can now reinvest the interim cash flows at the now high rate. So in red, the increased reinvestment income that comes from reinvesting your interim cash flows, coupons, etc., at a higher interest rate. Now, I want you to look very carefully at this graph. There is really a very special moment in time in the future where the gains on reinvestment income would exactly offset the losses on, or the remaining losses on, the price drop that resulted from increased interest rates. And this magical moment in time here happens to be Macaulay duration. So it's absolutely no coincidence why we want the liability, which has a Macaulay duration of 10, to be exactly in line with the Macaulay duration of our portfolio. Now you have an answer if you never thought about it. It's because the Macaulay duration of my bond is the moment in time in the future where whatever gains I would have would be offset by whatever losses there would be. Meaning that if I was promised a yield of 5.1, I would actually make that yield if I wait until my Macaulay duration. Why? Because any loss from price would have been offset by gains on reinvestment. Of course, the opposite holds true, right? The opposite holds true. So here's the bond, and then interest rates went down. The bond goes up. If you wait, the bond will converge back to par at maturity. However, this is offset by, or balanced by, less and less reinvestment income as time passes. There is a great moment in time where whatever gains from price appreciation would be exactly offset by losses from lower reinvestment income. Why does it matter? Because that point mathematically is the Macaulay duration. It matters because when I buy my bonds today, I know that if I hold them until their Macaulay duration, I will earn the promised yield. And whatever turbulence would have happened, it would offset. Price and reinvestment would offset. Of course, subject to constantly making sure that the Macaulay duration of the assets is exactly equal to 10 years, which happens to be the Macaulay duration of the liability. This is the real reason behind condition number 2. Now, condition number 3 is super confusing. I get this question every time. Convexity is good. You want more convexity. Then why do they ask us to minimize the convexity of the assets? Because in this particular context, convexity is very bad. Because convexity, guys, is associated with dispersion. The more dispersed the cash flows, the higher the convexity. Think of a 10-year zero coupon bond. It has one cash flow in year 10 and zero dispersion. it has the lowest convexity among all bonds with a duration of 10. Think about my two statements. Make sure you understand them. Statement 1, among all bonds with the same maturity, the zero coupon bond has the highest duration. Of course, a 10-year zero duration is 10. A 10-year coupon paying bond duration is less than 10. So among all bonds with the same maturity, zero coupon bonds have the highest duration. What matters to me more is statement number 2. Among all bonds with the same duration, the zero coupon bond has the lowest convexity. Lowest convexity. Great. Convexity is associated with dispersion. The more you have cash flows that are dispersed around the duration, the higher the convexity. There are two reasons why we want to minimize convexity. I'll end this point by explaining it in an analytical way, right? Or in a simplified way, let's say, and then by looking at it from really a practical perspective. Think about it like this and link with everything I explained so far. You have a 10-year zero coupon liability. It has a duration of 10. But remember, among all the bonds with a duration of 10, it has the lowest convexity. In a perfect world, what would have been the best asset to immunize that liability? A 10-year zero coupon asset. Problem is, it doesn't exist, or it might not exist. So I'm trying essentially in an immunization strategy to buy coupon paying bonds that would mimic to the largest extent possible the 10-year zero coupon bond that doesn't exist. Think about it. In other words, if I could buy a 10-year zero coupon bond to hedge my 10-year zero liability, that would have been perfect. Zero reinvestment risk, zero price risk, zero everything. Unfortunately, it doesn't exist. So I want to buy coupon paying bonds that mimic as much as possible the zero coupon bond that doesn't exist. Now link it with the statement that among all bonds with the same duration, a zero coupon bond has the lowest convexity. So guys, here goes your answer. To mimic the zero coupon bond that doesn't exist, you want to try to lower your convexity as much as possible, because the 10-year zero coupon bond that doesn't exist, and which is the perfect instrument, has the lowest convexity possible that you can arrive at, that you can reach. So you want to try to minimize the convexity as much as possible so that your bond portfolio, the one you're using to immunize your liability, behaves like the ideal 10-year zero coupon bond that doesn't exist. This is conceptual. I hope it's clearly understood. Now, from a practical perspective, it's way more important than you think. This is your 10-year liability. Of course, the 10-year zero coupon bond doesn't exist, or else I would have bought it. Condition 3 asks me to minimize the convexity of my asset portfolio. It's another way of saying, please try to buy bonds as close as possible to 10 years. This is what it means when they say minimize convexity. It goes way beyond just trying to mimic a bond that doesn't exist. It's actually reducing non-parallel risk changes. Guys, if instead of buying these bonds, in red, you actually buy this one and this one, where the average is actually 10-year, it's fine. Condition 2 prevails. The Macaulay durations are equal. But this is the problem. 6-year, 14 years. What happens to you if the 6-year yield goes up sharply? The 6-year rate goes up sharply. Only this one, key rate. Your portfolio is destroyed. because your portfolio of assets has a 6-year bond which will suffer dramatically, while your liabilities will be unimpacted. So really, it's not about just mimicking the zero coupon bond for the sake of mimicking it. It's also to make sure that by clustering the cash flows of your assets around the Macaulay duration of 10, you are minimizing the risk that some rate on the curve would change and your assets and liabilities will behave differently. By clustering your assets around the 10-year point, then the changes in the curve will be similar for your assets and liabilities. The impact will be similar. And this is the reason why we minimize convexity. Clear this confusion, because for many people, convexity being positive, you want to try to maximize it. No, in this case, you want to try to minimize it. All right. So that's it for immunization. I think that we will stop here, right? For currency management, what you can actually look at, what you can actually look at are 3 things really, right? To remember them. So first, to decompose the return in your domestic currency. So it's the return of the asset in the foreign currency, plus the return, plus or minus the return of the FX itself, plus the return of the FX times the return in the foreign currency, because the FX changes would hit your capital and your returns. The famous variance portfolio for a stock denominated in a different currency. And an important concept is the minimum variance hedge ratio, where you are not hedging only for one source of risk. For example, you are a USD-based investor and you are buying stocks in euros. The problem is you have 2 sources of risk. The euro will change, the value of the stock will change, so how much to hedge? If you bought 1 million euros in stocks, then how much should you hedge? Should you sell 1 million euros forwards? Not really, because maybe when the euro goes up, the stock price goes down, so you need to hedge less. So the minimum variance hedge ratio is basically trying to come up with the optimal hedge by regressing the return in your domestic currency against the return of the currency itself or the hedging item, right? By solving for beta here, for example, imagine beta is 1.4. This means that for every 1% change in the euro, you are actually seeing your portfolio change by 1.4. This can only mean that when the euro goes up, the stock has a tendency to go up. So hedge more, right? In this case, hedge, for example, if it's 1.4, then for every 1 unit exposure in the euro, you need to hedge 1.4 when you sell the euro forward. That's also quite important concept from an analytical perspective. Unfortunately, I think that time will not allow us to go deeper in that, because 3 hours is already a lot, right? And of course, the level of focus would drop. I hope, guys, this session was beneficial. Once again, I thank the CFA Society of Lebanon and Alia, its president, and also all the board. I also thank CFA Society Egypt, Cyprus, and Kuwait for also sending the invite to the participants. I hope the session was beneficial. I hope the recap was actually helpful in preparing you for your coming exam. There will be several sessions potentially in the future. So if you like the session, you can simply subscribe to the channel, and whenever I release level 3 videos, you guys will be notified. Of course, if you have any questions, you can simply go on the video when it's posted and actually post your question there, and I will make sure to enter and reply. So thank you everyone again, and have a great evening. Take care. Thank you everyone.